This is Nightly Business Report with Bill Griffith and Sue Herrera.
Reverse course. Stocks bounce back on reports that trade talks between the U.S. and China are still on, and investors exhale for now.
Turning point, stocks, bonds, and commodities are suddenly volatile. So what's next for some of the most widely held asset classes?
New questions. Did Boeing wait to alert airlines and regulators that a safety alert wasn't working? A new report suggests it did. Those stories and more tonight on Nightly Business Report for Monday, May 6th.
And we do bid you a good evening, everybody, and welcome. Well, the trade talks are on. Reports late this afternoon said that Chinese negotiators are now still planning to come to Washington this week to continue hammering out a deal with the U.S. That gave stocks a lift after they had already suffered steep losses this morning when investors were concerned that the Chinese were thinking about pulling out of the talks. The initial sell-off was sparked by a tweet from President Trump in which he threatened to impose additional tariffs on Chinese goods this Friday. He said that progress was moving too slowly, and he accused China of trying to renegotiate parts of a deal that had already been agreed to. Those comments caught the global markets off guard. Shanghai fell more than 5% overnight. And after a very rocky start this morning, the indexes here in the U.S. were down, but well off their lows. The Dow was down 66 points at the close. It had been down more than 400 at its lows. The Nasdaq dropped by 40, and the S&P was down by 13. And then very late this afternoon, there was a meeting at the Trade Representative's office in Washington. Our Kayla Tausche was there. And Kayla, you found out there's a timetable now for the restart of the talks and for the tariffs, right?
That is correct, Bill. The Chinese vice premier is expected to be in Washington for talks Thursday evening and Friday. So the show will go on, but this round of negotiations, the 11th round between the U.S. and China, will be shorter and perhaps a little bit more tense, considering that the U.S. Trade Representative Ambassador Robert Lighthizer said these heightened tariffs will go into effect at the end of the day Thursday, 12:01 a.m. on Friday. Those tariffs go up to 25%. From 10% on $200 billion of goods imported from China.
Kayla, last week when leaving Beijing, the Treasury Secretary said the meeting had been productive. So what happened to precipitate this kind of breakdown?
The Treasury Secretary acknowledged this afternoon to reporters that the meetings had been productive and that both negotiators felt there had been substantial progress that had been made through these rounds. But he said over the weekend, the U.S. negotiating team was given new information by China where they reneged on previous commitments and that there was a significant erosion in what China was willing to put on the table. The Treasury Secretary said that it was very clear that the language that was changed would have the potential to change the deal dramatically. He said the president was willing to hold off on increasing tariffs so long as there was progress. And once China backtracked on that, they didn't feel there was.
So what are you hearing? What's the likelihood of a deal either this week or at all?
Well, the Treasury Secretary said there's the potential for talks to get back on track. But it does appear that the U.S. negotiating team has lost faith in China, that they felt that they had certain things that had been agreed to that were underpinning the deal, certain commitments from China that then at this very late stage of the game, China was willing to back out of. That certainly gives U.S. negotiators pause, though they are cautiously optimistic that there could be some resumption of talks, even if not a deal this week as expected.
Kayla Tausche in Washington for us tonight. Kayla, thanks again.
On Wall Street today, it was all about Washington. As we mentioned, stocks moved in lockstep with headlines about trade. Bob Pisani witnessed all of the day's ups and downs from the New York Stock Exchange.
Stocks sold off very early on, but we quickly rebounded off the day's lows. In fact, the low print of the day was right at the open, and it was mostly up from there. So right away, we saw the usual knee-jerk reaction of selling trade-sensitive names, semiconductors, and large global industrials like Caterpillar or Cummins. But even that sell-off has been pretty half-hearted, and we met with buying by the middle of the morning. The additional tariffs, they sound pretty serious, but the market reaction indicates that traders don't believe that an all-out trade war is imminent. Stocks bottomed out in the morning, and they ended right around the highs for the day, indicating initial sellers were not met with any waves of additional selling in the middle of the day. Why is this? Well, traders believe that despite this speed bump, a trade deal will eventually get done. We're not sure about the details, but President Donald Trump is going to continue to do everything in his power to prop up the market ahead of next year's presidential election. That's just what the market tends to believe. Just look at what happened with the VIX today. That's the volatility index, Wall Street's so-called fear index. That spiked to almost 19 overnight, but fallen back down to 15 by the close today, indicating options traders aren't feeling the need to go out and buy more protection, because that's what that reflects, that VIX. But don't kid yourself. If a real trade war were to develop, the market's very vulnerable. It is expensive right now, and a trade war would definitely reduce global growth and earnings prospects. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
And billionaire investor Warren Buffett acknowledged today that a dangerous game is being played by the world's two biggest economic superpowers. Mr. Buffett made his comments during a wide-ranging interview on CNBC today with Becky Quick when she asked him about the potential for an escalation in trade tensions.
What do you think about the potential for trade tariffs coming back on and what that might mean for the trade talks?
Well, I can't gauge how both sides will play the game, and they're always, some people negotiate different ways, and if we actually have a trade war, it will be bad for the whole world, and could be very bad depending on the extent of the war. But there's times in negotiations when you talk tough. The one thing you can't do, though, is you can't shake your fist first and then shake your finger later on. I mean, that is not a technique that works well.
Mr. Buffett did not try to put odds on how the trade talks would turn out or whether President Trump would follow through on his tariff threat.
But that threat has economists crunching numbers to figure out the impact of tariffs on the economy. Steve Leisman has that part of the story.
President Trump's tweet that he would slap additional tariffs on $200 billion of Chinese goods threatens the U.S. economy with deeper and longer negative impacts from the trade war. Economists estimated a modest impact from existing tariffs, saying it would shave about 20 points off of GDP this year. It's a small amount, but about half of the estimated positive impact of the tax cuts. Economists had thought those negative effects would go away in 2020. But they now may have to go back into the forecast and, with 25% tariffs potentially on tap, downgrade the forecast even more.
Those kinds of tariffs are going to have a macroeconomic impact here. They're going to hurt American consumers if we really went to 25% on all Chinese imports. It's going to make some products in the U.S. more expensive that are used by industry.
There's also a negative impact on business confidence and on global growth that could hurt the U.S. economy. Barclays estimates that the tariffs could reduce Chinese growth by 0.3 to 0.5%. If there's upside, it only comes after several years of tariffs, economists say, when and if U.S. companies can replace the more expensive foreign goods. Other negative impacts could come from lower stock prices. A recent CNBC Fed survey showed 77% of market respondents thought there would be a U.S.-China trade deal this year. Analysts would have to recalculate earnings of U.S. companies who use more expensive Chinese components and make other adjustments based on if and how China might retaliate. Like with most wars, in a trade war, economists believe no one really wins. For Nightly Business Report, I'm Steve Leisman.
And the president of the Philadelphia Fed said today that the trade war uncertainties are weighing on business and the economy. Patrick Harker said that he wants to see fair trade, but that all of the talk about tariffs was not healthy for the overall economy. He added that the biggest issue many firms now face is policy uncertainty.
So what might those renewed concerns over tariffs and trade mean for everything, really, from stocks to bonds to commodities? Here to talk about that is Ben Phillips, Chief Investment Officer with Event Shares, to talk about the equity markets. Colin Martin is Director of Fixed Income at the Schwab Center for Financial Research. He'll focus on bonds. And Scott Nations covers commodities. He is President of Nation Shares. Gentlemen, welcome to all of you. Thanks for joining our roundtable tonight. Ben, I'm going to start with you. I know that you and a lot of other people think that basically a lot of this trade war talk is already in the market, and the market thinks we will get a deal. But the comments late this afternoon seem to suggest that things are not moving quite as smoothly as the market thought. What do you think?
Well, I think that's right, that the market has been pricing this in. It's been a big driver of the rally year to date, in our opinion. And so I think you're right on that assessment. I think the market's also looking at today and saying this is part of Trump's negotiating style. He's a little bit of a brinkmanship, person. And so he's saying this is something that I need to talk about, I need to address. I think there was talk about him caving over the weekend. He doesn't like when people say that he's a caver or anything like that. So I think we're in a position where he's trying to show a stronger hand and that he's very serious about these negotiations.
Colin, fixed income is seen as the safety trade, and of course yields went down today, but at a time when the Fed last week signaled no rate cut anytime soon, so yields went up. So you're getting real mixed winds, crosswinds here for the fixed income markets. Where do you think rates are going with all that's going on right now?
Well, with tariff concerns, which can potentially slow global growth and lead to lower investor confidence, that can help pull yields lower. As well as stock market declines. When there's periods of market volatility, investors flock to the safety that U.S. Treasuries provide, and that demand pushes their prices up and pulls their yields lower. So this just supports our case at Schwab that yields are likely to stay low. Aren't they already pretty low at this point, though? They're pretty low, but the threat of tariffs opens the door for a potential rate cut. The Federal Reserve last week did spin a relatively positive outlook, but if we do see slower growth, both domestically and abroad, and if we see tighter financial conditions, that could lead to a cut by the Fed. Now, that can be a good thing for investors who own bonds because lower yields can push up their prices, right. But it still makes it more difficult for investors looking for yields.
Scott, handicap the reaction in the various commodity markets that you watch. I know that we would see reaction in copper, in oil, but the agricultural markets have been very sensitive and very volatile given this negotiating period.
Very much, Sue, and we would expect agricultural commodities like soybeans to really take it on the chin today, and they did. But you mentioned copper. I would also look at crude oil. Both of those probably give us the best window into what's really going on here because China manufacturing economy uses so much of both. And as you would expect, both copper and crude oil had really ugly opens, but they came all the way back and more. Copper ended up nearly 1%, crude oil up at least 1%. And so what does that say? That says that the market, which has a mind of its own, does believe that the trade deal is still on track and that we're likely to get a deal because both of those commodities would lead the market lower if we really had to throw in the towel on a trade deal.
Ben, we have a list of the companies that have the greatest revenue exposure to China. We're going to show you the top 5 here, and I'm struck by the fact that 4 of those 5 are technology related. In fact, they're chip related. And if we broaden this out to the top 10, 8 out of the 10 are computer chip related. I mean, it doesn't get any more basic than that when it comes to technology's exposure to these trade talks right now, right?
That's right. The tech companies are the greatest exposed. That's why you saw kind of pre-market and on the open, they were some of the worst performers, but they clawed their way back too. So some of them did come back. I mean, we were looking at Xilinx and Skyworks as 2 names that we own, and those are names that we recently just started building positions in based on our view of a little more progress on the trade talks. So we're waiting and seeing if those go down further. We're going to potentially look at it as an opportunity to buy.
If I can stay with you, Ben, you also say that the individual investors should maybe get a little defensive in healthcare and other sectors like that. What names on the defensive side do you like?
Yeah, so in healthcare, this is, again, different policies, not China trade, but we like, healthcare overall, but we like the managed care. So we like Anthem there. We like United Health, for example. And so there's, some of those managed care providers in healthcare. We own some Teladoc, and so we like some of the health tech companies as well. But those are some of the names in healthcare that are attractive in our view.
And Scott, before we let you go, you had talked about crosswinds, the crude oil market. You've got Saudi Arabia and the rest of OPEC that would love to see the price of oil go higher, and yet, if you get the trade tensions here and the tariffs go in, you're going to get a slowdown that's going to push oil prices lower. What are you doing here?
I think that when you look at crude oil, you have to look at the fact that the big producers overseas have done a really good job of moderating their production. That is, they've scaled back their production a little bit, and that's why we see crude oil prices a little bit higher than they were at the end of last year. I think they're going to continue to do that within reason. They realize that they do have to answer to the American people and to President Trump, and so they're not going to get ahead of themselves, Bill, but I would expect that they're going to continue to be disciplined when it comes to production. I think prices are likely to stay about where we've seen and maybe get near $70.
On that note, gentlemen, thanks so much for joining us tonight. Ben Phillips with Event Shares, Colin Martin with Charles Schwab, and Scott Nations with Nations Shares.
Time to take a look at today's upgrades and downgrades. Actually, a couple of upgrades tonight. Sinclair Broadcasting was upgraded to buy from neutral at B. Riley FBR. The analyst calls the company's recently announced deal to acquire 21 regional sports networks a home run. Price target $57. That deal was announced late Friday, and today the stock took off, soaring by 34% to $60.48. And Dish Network was upgraded to neutral from underperform at Credit Suisse. The analyst predicted that video subscriber losses will start to decline in the second half of this year. Price target now $34. Shares finished right at that level at $34.71.
Still ahead, what did it know and when did it know it? It's a question that's been asked before, and now it is being asked about Boeing.
There are new reports tonight that Boeing may have waited several months before notifying airlines and regulators that there was a problem with a safety alert system on the 737 MAX. That news and the increased trade tensions between the U.S. and China pressured that stock in today's session. Phil LeBeau has more for us tonight.
Shortly after Boeing delivered the first 737 MAX in 2017, the company discovered a safety alert on the plane was not working. The alert involves the angle of attack indicators, a vane on each side of the MAX nose that measures the flight angle and alerts pilots if the plane is in danger of stalling. And for some airlines, if the data from those indicators do not match up, there's a disagree alert to notify pilots in the cockpit. Boeing now admits it waited months until shortly after the Lion Air crash to tell airlines the disagree alert was inoperable. Boeing says the absence of the AOA disagree alert did not adversely impact airplane safety or operation. There's no indication the lack of an alert caused either the Lion Air or Ethiopian Airlines MAX airplanes to crash. And Boeing says its senior management was unaware of the issue until late last year. That's when the company told some airlines, like Southwest, about the MAX alert not working, while it waited until earlier this year to tell other airlines like United. Even the acting head of the FAA didn't know about the issue until late April when he saw a press report about it. The FAA says Boeing's timely or earlier communication with operators would have helped to reduce or eliminate possible confusion. After public outcry about the lack of alerts for some 737 MAX pilots, Boeing now says it will make angle of attack disagree alerts standard in all MAX cockpits. All of this has some asking, what did CEO Dennis Muilenburg and Boeing's board know? And why didn't the company act sooner to notify airlines and regulators? As those questions mount, the company has moved its chief legal counsel into a new position, advising Muilenburg and the Boeing board about the MAX crisis. Meanwhile, airlines continue to believe the 737 MAX will once again be flying sometime later this summer. All of that is contingent upon the FAA and regulators around the world approving a software fix for the plane. Boeing has yet to submit that fix for regulatory approval. Phil LeBeau, Nightly Business Report, Chicago.
Kraft Heinz will restate more than 2 years of earnings results. That's where we begin tonight's Market Focus. An internal investigation revealed employees fabricated transactions that increased the cost of products sold. The company said it will restate results as far back as 2016. Warren Buffett, whose Berkshire Hathaway is Kraft Heinz' largest shareholder, said the company has his confidence. The shares were up a fraction today to $32.77. Bausch Health reported better than expected earnings and raised its full-year outlook. The drug maker formerly known as Valeant recently had its dermatology business receive an FDA approval for its lotion to treat plaque psoriasis, which is a chronic skin condition caused by an overactive immune system. The company did miss on revenue, but investors didn't seem bothered by that. The shares jumped more than 8% to $25.48. Tyson Foods posted better than expected results, but warned African swine fever could impact the industry on a level never seen before. Tyson also voluntarily recalled nearly 12 million pounds of their frozen, ready-to-eat chicken strips over concerns that they might contain pieces of metal. But shares were up more than 2.5% today to finish at $77.05.
And then after the bell tonight, AIG beat analyst estimates as the finance and insurance company saw a notable rise in net interest income. This report also broke a 6-quarter streak of misses by AIG. The stock initially rose after hours and was unchanged in the regular session. It closed at $47.11. Occidental Petroleum has increased the cash portion of its offer for Anadarko Petroleum. Occidental's CEO says that she's working closely with Anadarko's management. She believes that upping the offer will remove any uncertainty about closing a deal. Occidental, of course, is trying to derail Chevron's agreement to buy Anadarko. The stock rose 1% today to $58.77.
Warren Buffett, as you may know, recently made a $10 billion investment in Occidental Petroleum, backing its bid to acquire Anadarko. Today, in that same interview with Becky Quick, he described his thinking behind that investment.
It's bet on oil prices over the long term more than anything else. It's also a bet on the fact that the Permian Basin is what it's cracked up to be and all of that sort of thing. But oil prices will determine whether almost any oil stock is a good investment over time.
Buffett's investment in Occidental is contingent upon Occidental being successful in purchasing Anadarko.
Coming up, superheroes have speed and strength, and the Avengers have both when it comes to raking in the money.
Disney's Avengers Endgame has gone where few films have gone before, marking yet another milestone for the film and the entertainment industry. Julia Borston has the details.
Avengers Endgame continues its record run with about $2.2 billion in ticket sales. Never before has a film generated such a high box office in such a short period of time. It's only the 5th film ever to gross over $2 billion worldwide. Now Avengers Endgame is the 2nd biggest film ever behind Avatar. It drew $2.8 billion in worldwide ticket sales back in 2009. Bolstered by Endgame, Disney is dominating the box office, responsible for 29% of all tickets sold in North America this year. And its dominance is expected to continue, with live-action Aladdin and Lion King films due out this summer, along with Toy Story 4. And Endgame has been a big win for theaters, drawing back a broad audience to the big screen after the box office had declined by double digits earlier this year. One advantage of getting audiences back: the opportunity to show trailers to get them excited about upcoming films, including Spider-Man: Far From Home, hitting theaters in July. For Nightly Business Report, I'm Julia Borston in Los Angeles.
David Hager joins us right now to talk more about the Avengers milestones, Disney dominating at the box office. And by the way, they're reporting earnings on Wednesday. What should we be expecting? He is the media analyst at Edward Jones. Have you seen the movie?
No, I haven't myself, but my daughter has been dragged to it by her boyfriend already.
These results won't be in Disney's earnings on Wednesday, but it's certainly going to be pretty good for them down the road, don't you think?
Sure. Certainly for the June quarter, it's going to be a big positive for the studio part of the business. But interestingly, looking at the March quarter, the studio business may be having a little bit of a tougher comp, just with having had Black Panther come out a year ago and bringing in a strong result. And certainly the Captain Marvel movie this quarter had a solid impact, but could make for a little bit of a tougher comp in the studio part of the business.
What about their overall pipeline of content, though, David? I mean, they seem to be kind of in the sweet spot, even taking the Marvel franchise out of the equation.
Yeah, well, certainly looking through the current calendar year, it looks like Disney could have a very strong slate of movies coming up. Obviously, beyond Avengers, we have the next edition of the Toy Story franchise. There's another edition of the Frozen franchise coming up, and then finally in December we have the next episode of Star Wars coming out. So, just a few of the many movies that Disney has on what appears to be could be a very strong slate this year.
But briefly, you do have some concerns about some of their media networks and some of the other divisions within the company, right?
Yeah, certainly. And looking at the March quarter, it's going to be interesting because this is still just Disney without any of the impact of Fox in the picture. And as you said, the Avengers movie is not in the quarter. And so the rest of the business, the media networks will be looking for hopefully the loss of subscribers to continue to moderate. It did slow down a little bit in the December quarter. And then certainly in the theme parks, looking for steady growth, although there could be some seasonal impact with the way the Easter week this year falls into the June quarter rather than in the March quarter as it did a year ago.
Quickly, do you like the stock? Would you buy it here?
Yes, we're positive on the stock. We feel very positive about the upcoming Disney Plus online service that's going to be rolling out and the breadth of content that we feel that Disney can offer on that service with its own library plus the Fox library coming into the picture as well.
Very good. David Hager with Edward Jones. Thanks again for joining us tonight.
Yeah, thank you.
Here's a look at the final numbers on Wall Street today. The Dow closed down 66 points, 26,438, but it had been lower by more than 400. The Nasdaq dropped 40 and the S&P 500 slid 13. And that is Nightly Business Report for tonight. I'm Sue Herrera. Thanks so much for joining us.
I'm Bill Griffith. Have a great evening. Cough.
After we get off.
All right. We'll see you tomorrow.